In this video, we're going to be looking at David Eifrig's newest teaser, where he claims Americans risk losing 40% of their wealth. We'll fact-check all the claims David makes and reveal the stock he claims could 10x. This way you don't have to buy his newsletter. Just keep in mind, no paid or proprietary information is given away here. It's all guesswork based on clues from a publicly available sales presentation. David Eifrig doesn't have much of a recent track record to investigate because he's been the CEO of MarketWise, the company that owns Stansberry Research, and the company that tried to get my YouTube channel banned. Because there's no recent record, we'll just dive into breaking down the teaser. Here's what the headline reads. Former Goldman Sachs exec and public company CEO breaks his silence. A strange day is coming to America, and you could lose 40% of your wealth. This plan is all written down in black and white. It's gone viral in hedge fund circles, yet nobody on Main Street understands the Mar-a-Lago Accord. Eifrig continues and says, I'm speaking out today because I need to share a critical financial message. In short, a very strange day is coming to America, and I predict it'll send one particular type of investment absolutely soaring, while devastating those who remain in the dark. Eifrig is hinting at something he calls the Mar-a-Lago Accords. Here's what to know about this. The Mar-a-Lago Accord is not an official government policy or signed agreement, but rather a theoretical economic proposal named after Trump's Florida estate that outlines potential policies a second Trump administration might pursue. According to the Council on Foreign Relations and TD Economics, the plan could involve tariffs on imported goods, currency intervention to weaken the US dollar, negotiations with other countries using US security guarantees as leverage, and Federal Reserve support to manage market reactions. The concept was originally outlined by Stephen Moran, who now serves as chair of the White House's Council of Economic Advisors. According to Eifrig, this has been done before at the 1985 Plaza Accord. Here's what happened there. The Plaza Accord, signed on September 22, 1985 at the Plaza Hotel in New York, was a formal international agreement between the United States, Japan, West Germany, France, and the United Kingdom, aimed at deliberately devaluing the US dollar to address trade imbalances. The Stansberry presentation correctly notes that the accord led to a roughly 40% decline in the dollar's value over the following 2 years, with the dollar falling from around 240 yen to approximately 145 yen, a depreciation that had major consequences for global trade and investment flows. Unlike the hypothetical Mar-a-Lago Accord, the Plaza Accord was a coordinated, internationally supported effort involving central bank intervention. Today's global economic landscape is vastly different, making the comparison more illustrative than literal. If Eifrig is correct and Trump is trying to devalue the dollar intentionally, this would be the actual consequences. A weaker dollar can have both positive and negative effects on your finances, depending on your personal situation, investments, and spending habits. On the positive side, U.S. exports become more competitive, which can boost profits for American companies with significant international sales, and international investments may yield higher returns when converted back into dollars. Commodities priced in dollars, such as gold, also tend to rise in value when the dollar weakens. On the negative side, imported goods become more expensive, potentially driving inflation higher, while travel abroad costs more for Americans, and dollar-denominated assets may lose relative value compared to foreign holdings. The key takeaway is that while currency shifts can create opportunities, they also bring risks. Instead of making dramatic changes based on predictions, a diversified approach remains the best way to protect against the uncertainties of currency fluctuation. Let's look at the clues Eifrig leaves us now to figure out the stock he wants you to buy to protect yourself. First, he says the investment has to do with gold, but he says not physical gold bullion. This is nothing you need to buy a safe or a vault for. He also says it's not a gold ETF. And he says my number one gold stock is not a mining stock. So all that's left is a gold royalty company. A gold royalty company is a firm that finances mining projects in exchange for a percentage of the mine's future gold production or revenue, rather than operating mines itself. This business model gives investors exposure to gold prices and mining upside without the risks and costs of running a mine. Eifrig also says, and what about my number one gold stock? It went so high, so fast. Between 2001 and 2008, this stock soared more than 10,000% and peaked as high as 16,000%. And Eifrig finishes by saying, when gold started ripping higher again after the financial crisis, the same thing happened. Gold rose 150% in under 3 years, and gold stocks did even better. But my number one gold stock took the crown, soaring as much as 293%, nearly doubling gold's return. Here's my point. When gold takes off, this little-known stock has a history of soaring far higher. It happened again in 2016. Gold rose 26% in less than a year. Gold stocks, just like the other examples, did far better, rising 161%. But my number one gold stock jumped 300% in less than a year, more than 10 times higher than gold itself. And the stock is under $20. I'm going to reveal the stock in 15 seconds, but before I do that, I want to remind you to sign up for my free report on the top 10 stocks to buy and hold forever. This report comes with no gimmicks, no get-rich-quick nonsense, just solid long-term investments you can actually feel confident owning. Click the link in the description to get your copy right now. The stock being pitched here is Seabridge Gold, and you can see the stock movements match the ones Eifrig describes. It's under $20 and it's a gold royalty company. Here's what to know about this stock, and after I'll tell you if I'd buy. Seabridge Gold is a Canadian exploration company that was originally founded in 1979 and later renamed in 2002, with its headquarters located in Toronto. The company's business model revolves around acquiring gold projects when prices are low, expanding their resources through exploration, and then either selling or partnering on those projects once they reach the production stage. This strategy has allowed Seabridge to position itself as a major player in North American gold exploration. The company is publicly traded under the symbols SA on the New York Stock Exchange and SEA on the TSX, and currently has a market capitalization of approximately $2.01 billion. Seabridge Gold's resource base is anchored by the massive KSM project in northwest Canada, which holds the world's largest undeveloped gold resource. The project is already backed by environmental approvals and permits, with a projected 33-year open-pit mine life. Financial estimates give it an after-tax net present value, NPV 5%, of $7.9 billion, with projected total costs of just $601 per ounce of gold after credits, making it one of the most attractive undeveloped assets globally. Beyond KSM, the company also owns the Courageous Lake project in the Northwest Territories, further expanding its pipeline of large-scale gold opportunities. Altogether, Seabridge has a measured and indicated resource base of more than 88 million ounces of gold, 19.4 billion pounds of copper, and 414 million ounces of silver, positioning it as one of the most resource-rich exploration companies in North America. Seabridge Gold's financial profile reflects its status as a development stage company. The stock currently trades at $19.65, with a 52-week range of $9.40 to $20.55, giving it a market capitalization of $2.01 billion. Year to date, the stock has delivered an impressive return of plus 63%, significantly outperforming the S&P 500's plus 12% over the same period. Despite this strong performance, Seabridge remains pre-production, generating no revenue, and reported a net loss of $45.44 million over the trailing 12 months. The company maintains a healthy cash position of $128.06 million, which provides a cushion for ongoing development and exploration activities. With a debt-to-equity ratio of 56.64%, Seabridge has some leverage but remains manageable given its stage of operations. Compared to major gold producers, its market cap is only a fraction, highlighting both its speculative nature and the potential upside if its world-class projects move toward production. The gold market in 2025 has been marked by a strong rally, with prices climbing 30% year-to-date and reaching a peak of $3,500 per ounce in April. This surge has been driven largely by persistent trade uncertainty, heightened geopolitical risks, and rising concerns over a potential global recession. Central banks have remained aggressive buyers, with purchases expected to total around 900 tons for the year, while exchange-traded funds have added 310 tons year-to-date, boosting global holdings by 10%. Looking ahead, JP Morgan Research forecasts gold prices to average $3,675 per ounce in Q4 2025 and potentially climb to $4,000 per ounce by Q2 2025-2026. Continued safe haven demand, gold's role as an inflation hedge, and sustained central bank accumulation are all seen as key bullish drivers supporting these price targets. The competitive landscape in the gold sector is dominated by major players like Newmont, Agnico Eagle, Barrick Gold, Wheaton Precious Metals, and Franco-Nevada, with market capitalizations ranging from nearly $39 billion to over $86 billion. In contrast, Seabridge Gold, with a market cap of just $2 billion, is a much smaller player, but stands out for its unique positioning. The gold mining industry as a whole represents roughly $815 billion across 111 companies, with a strong presence from Canada, the United States, Australia, and South Africa. The sector is a mix of producers generating steady cash flows, royalty companies offering lower risk exposure, and development stage companies with higher speculative potential. Seabridge differentiates itself by holding the world's largest undeveloped gold resource base, complemented by substantial copper and silver resources. With permits already secured for its flagship projects, Seabridge is well positioned for future development, though its pre-production status gives it a higher risk/reward profile compared to established producers. In conclusion, Seabridge Gold represents a unique opportunity for investors looking to maximize their exposure to rising gold prices. With the world's largest undeveloped gold resource, the company offers exceptional leverage to future price appreciation, particularly as forecasts point to gold potentially reaching $4,000 per ounce by 2026. Its strong year-to-date stock performance of 63% underscores the market's confidence, while existing environmental approvals and a projected 33-year mine life help de-risk development of its flagship KSM project. Unlike established producers, Seabridge carries a higher risk-reward profile, making it more suitable for long-term investors with a high tolerance for volatility. Beyond gold, its significant copper and silver resources add further upside potential. Taken together, Seabridge stands out as a development stage company that could deliver substantial long-term returns for those willing to bet on both its assets and the broader strength of the gold market. So what do I think? Seabridge Gold is very tempting. They own one of the largest undeveloped gold projects in the world. On paper, the upside looks massive. If they ever bring it into production, the leverage to gold prices could be enormous. But here's where reality hits. Seabridge is still pre-revenue and pre-mining. That means every dollar depends on the future. They don't produce gold today. They don't have royalty income. They're not generating cash flow. All the excitement you see in their stock price is largely based on what might happen down the road. In other words, a lot of that future potential is already baked in. Compare that to established royalty companies like Franco-Nevada or Wheaton Precious Metals. Those names already generate steady streams of cash flow. They pay dividends. They've weathered gold cycles before. They carry less risk because they're already proven. Seabridge is different. It's a pure bet on size. If things break right, it could soar. But if costs balloon, financing dries up, or gold prices stumble, investors holding the bag could lose years waiting for progress. That's why I'd call Seabridge a borderline buy. The potential is higher than almost anything in the sector, but so is the risk. This isn't a stock for the faint of heart. It's a speculation, not a foundation. Don't forget to grab my free report on the top 10 stocks to buy and hold forever by clicking the link in the description. And if you want to learn more about tiny gold stocks, click the video below. There you'll see a 75-cent stock that Brian Hicks claims will make millions.